Hey everyone, welcome to the week review. This week was relatively stable and uneventful, aside from that scare on Thursday from the Trump Elon drama, which got bought back on Friday. We didn't get anything spectacular, and I kind of expect more of the same until CPI. Maybe we get some type of activity from the outcome of the US-China meeting from Monday, but don't really expect anything that spectacular. Maybe we'll get a move in Chinese equities if it's favorable. But other than that, it shouldn't affect the entire market significantly. Friday we got kind of a VIX crush, a classic VIX crush Friday. But what I like to talk about today is yields and the dollar. I posted on sometime that's this week about USD Euro, which looks like this on the monthly chart. And in my opinion, the dollar has no reason to be this weak. First of all, we have the central bank differential. If you remember, this is the 2021 and 2022 cycle in which the dollar was blowing everything up because it was going so high so much. And one of the reasons and explanations at the time was that this is happening because of the rate differential. Basically, the Fed had already started hiking and was hiking aggressively in this interval, while the ECB started hiking very late. If I remember correctly, like at least 6 to 9 months after the Fed, they had their first hike, and it was like 0.15%, something like that. Something totally insignificant. They kept going for a lot longer, but at the time, one of the explanations for this was the rate differential because uh, Fed was hiking, the yields on US um, bonds was much better than the yield on European bonds, so it made sense for money to go in the dollar. Uh, and one of this drop here was partially because the Fed hiking cycle was ended, and the ECB kept hiking, and again the rate differential was moving in favor of the ECB at the end there. But right now, where are we now? If this was an explanation then why the fuck is the dollar going down now and being this depreciated relative to the euro when the Fed only cut once and the market completely disregarded that because we have yields that are way above the Fed fund rate at the moment. Like there's a premium of what, like 50 basis points, maybe even more, depending on the. Let's just take the 10 year. Uh, I think we are above the FFR. The FFR is 4.325 or something, for between 425 and 4.5. So we are above the Fed funds rate on the 10 year, which is the market acting pretty crazy if you ask me. Now, so the ECB cut 8 times, the Fed cut 1 times and is being ignored. And in this scenario, why is the dollar this weak? And you can say it's the tariffs, but the theory for tariffs is that imposing tariffs will appreciate the currency, not depreciate it, in the case of the dollar. So, in my opinion, the way things look right now on DXY, we are at imminent dollar reversal. We need a catalyst and we need that market to respect that catalyst. Most likely, that catalyst will be the inflation prints next week, which I expect to be cold. Main reason is we will not see the tariff impact quite yet. The only items that can see a tariff impact right now are perishable items like food, because you cannot stockpile large amounts of food. You have to import it fresh, and it will be affected by tariffs immediately. So any type of food things, we might get some food inflation, but any other item should be excluded because we had that spike in imports in February, March uh, as a front run. We shouldn't see impact from tariffs on any other items. So with this, we shouldn't have a high impact on inflation. So the disinflationary impact should have momentum. So we should see a very cold print on inflation yet. Maybe we see a spike later on, but given that tariffs are paused, I don't foresee this until the larger tariffs kick in, potentially after July. For now, the impact should be quite negligible on CPI. And one of the reasons why yields are so high and the dollar is so low is this, like inflation expectations. And on the other side, it's the deficit thing, which the deficit thing is more like an excuse. It's more narrative driven. It's not really that real or important. I mean, it is over the long run, but over the short run, it's completely irrelevant. And I think the market is putting too much emphasis on the deficit part and having kind of a tantrum right now. But the market is wrong. The bond market is wrong, in my opinion, at this time. And that will be confirmed by a very cold inflation print. If the inflation print is hot, then the market is right, and I'm stupid and I don't know what I'm saying. But let's start from the assumption that the inflation print will be cold. And looking at DXY, we have kind of the same type of divergence we had at the previous bottom. I think this is a deviation that needs to be ignored, just as I think that looking at 30-year yields, just because I have less line drawn here, I think this is a deviation caused by the war, which is not by the war. This was the October 23 bottom, but it's a deviation that is irrelevant. What is relevant is this big rising wedge, and we might get like a blow off move in it. I don't think we go higher than this if the inflation print is hot, or maybe like even if the inflation print is cold, but like a market tantrum kind of thing. But I think a reversal in yields is imminent, and we should be getting at a minimum a retest of the lower trend line in all yields. Like this, the fact that the 2-year yield spiked on Friday from a normal jobs report is completely bonkers to me. We still have this ghost print here at 4.28. Maybe we get it now, maybe we get it later. But for me, this move in yield is completely crazy, and I think yields should be significantly lower, and the dollar should be significantly higher. The dollar, what is also kind of confusing is that on Friday yields spiked while the dollar spiked, which they have been positively correlated lately, meaning when inversely correlated, I mean, because when yields went down, dollar went down as well. And on Friday, they they while yields went up, dollar went up as well. So kind of strange. I think the dollar is right here, and I think the dollar is imminently going to go up. Now going back to USD Euro, this is supported by other behavior in other currencies, other pairings. Like all of them look like they have a bullish divergence, and if we get the dollar turning, we will get yields turning. And going back to equities based on this, so this is USD GDP, this is USD China, yuan. They all have bullish divergences. JPY, JPY already making higher low, but CAD as well. And so on. So going back to equities, like the market has been relatively calm lately. Like we've only had that hiccup when the Trump Elon drama, but other than that, we've basically been going nowhere and only slightly grinding up. And I think we're at a decision point where if the CPI print is called and the bond market accepts this, that they are wrong and they've been overpricing yields, and dollar bears accept they are wrong and we get a dollar reversal, this will be a mega fuel for equities, and it will cause a breakout here of epic proportions. Um, I posted also some flow. This one caught my eye, which is TNA. TNA being actually I can open it here. TNA being 3x leverage IWM basically, and getting this kind of activity in a name that doesn't really see that much activity, like getting this was like previous volume. Getting volume on 15K or 5K even on TNA is out of the ordinary. And being 3x leverage as well, it's out of the ordinary. So this doesn't see volume that much. It's a 3x leverage, and calls on 3x leverage is rare and should be listened to when it happens. So this being said, someone is extremely bullish for small caps, and small caps depend a lot on yields. It's surprising that the small cap rally held in spite of yields spiking on Friday. I don't expect this to continue. So if yields go higher, IWM should go back to dumping. But I think this time IWM is right and bonds are or bond yields are wrong. And if the market accepts the core CPI print next week, we will get a breakout of epic proportions here. Like we go above 600 and we don't look back. Expectation is like 650 by September. Like it won't be all up and up and up and up. Maybe we get to 620 immediately, but after that we have to pull back because we get to OPEX and stuff like that. But target would be like 650 for summer, maybe sometime in September, a large pullback in October. But for now, that's kind of it. Uh, so yields are wrong, dollar is wrong, being weak. And if this proves to be true, we get a massive breakout here and we go significantly higher. IWM already broke out here, but we haven't recaptured the horizontal level in an aggressive way. So next week I would expect, like I said, quiet for the first couple of days. And when we get the CPI print, and if it's a core CPI print and everything that I said becomes reality, we get like a plus 3% to 5% gap up on IWM. Uh, this has happened multiple times before. This was also a core CPI print, July 11, plus 3.59, and it had continuation. So this type of move is possible again in IWM. 10% move in IWM is quite possible and plausible if we get a core CPI print and we have yields calming down. And let's say it starts from this. So we would go to 230. That's kind of the target if we get a core CPI print and everything with the dollar and the yields confirms. Also, I think this was a not this wasn't a CPI print. This one was a CPI print. 3.9 and continuation. Yeah, this was a CPI print. And how big was this rally? 9.6%. So expect 10%, which is 230 for IWM if we get that level of coolness. Then we will pull back, obviously, same like we did here. Maybe we don't get this huge drop again, but for now, this is my forecast. But it all depends on what the market does. If the bond market doesn't show acceptance or the dollar doesn't show acceptance, meaning in spite of the core CPI print, we don't get a drop in yields, a significant drop in yields, or we don't get the dollar reversing quite yet, we basically the market remains in denial. And I don't think we will get like huge moves, but basically following the trend, we delay for another month. At some point something has to give, meaning either the data breaks down and we actually get a spike in inflation and the bond bears get uh, uh, get their vengeance basically, or it's confirmed that they were right, or they give up and we get this type of rally. So this either every time we get a catalyst that could prove or disprove this thesis, we have a chance to have the breakout move. Once one of these is CPI. So next week we have CPI. If it doesn't happen next week or in a couple of days afterwards, so it has to happen by end of week, basically this type of move or the beginning of it, not all of it. Then it's delayed by another month, and we keep going sideways until around here. This is like July 16th. When is the next CPI print? on the 10th, so around here. So this is it's a time window. We have it next week, which is the 11th. If it doesn't happen on the 11th, we have to go here. Let's say the 9th. So something like this. If it doesn't happen now, we can still go sideways for a while, and equities would go sideways, everything would go sideways basically. Like if we don't have that big move up, then everything gets postponed for another month, and equities can still go higher, but it will be a higher at the same rate as now, like slow grind up, potentially some more pullbacks. Uh, the blow off move only happens if it's a call print. And if it's a hot print, then we get the reverse direction in which we potentially drop in equities as well, and we go to the other side of the range. The other side of the range being this 576, 573 area right now. It can go lower. Like imagine this can be also a broadening formation. I do it like a horizontal range, but if I take this and this, and let's thicken them. And I'll do another color just for the sake of it. Let's do orange. I don't like orange, not visible enough. I'll do green. It's green. So uh, this can also be a broadening formation, and broadening formations are basically price discovery formations, meaning the market doesn't know what to do. It tries to go higher, it gets rejected. It tries to go lower, it gets rejected. So this type of move is also plausible, and we can go all the way down here to the China deal gap. I think it won't happen from CPI alone, obviously. Most likely we will go below the yearly open if the market doesn't like the CPI print next week, so below 590, and then we get another catalyst, and that catalyst takes us lower, and then we get another catalyst, and it takes us lower, and just when people believe that, oh my God, we made new lows, everything is going to shit, then the market reverses and it goes higher, and don't need to take this literally. Like it will likely be a bit higher following this AVU up, most likely something like this. So like 560, just below 570 in my opinion. So something like this. 570. And again, people will believe, oh my God, new lows. This shit is going to zero. And then it just reverses and goes to the other end all the way here, because that's what it does when it's broadening like this. So if we don't get the big breakout right now, I think it's very likely that this is a broadening formation. And we will go down, we will go up, we will move in this range here until we finally get a resolution. For now, I am flipping back to bullish, mostly because this move in the dollar and this move in yields are completely nonsensical. Like what is happening in reality does not accommodate this type of move. Like I said, it's more like the whole debt ceiling, not the ceiling, the deficit thing, which is mm, for some reason the market decided to make a stand on this right now, but it's completely irrelevant, and more than likely will become a non-issue very quickly. It's just more like the the administration is to just change messaging a bit, and it should be okay. Now, the biggest hop after this is what happens when the tariff postponement until July 9th happens. But I expect we will get some resolution or some positive catalyst for this either way. The basic assumption, if the market will break out, is going to be that it will be extended, and whatever tariffs we have now, with slight modifications, but doesn't allow for big modifications, will remain as they are now, like 10% baseline. Maybe someone gets 40% like China, maybe a couple of names out there get 15% and so on. But it should not be bigger than what we see now. So either another postponement or just slight increases in specific areas. That's what the market will assume. So if we get started on that rally and keep going higher and higher and higher, anything that contradicts the narrative that tariffs will remain at the current levels is going to be bad. And why I think tariff remaining at these levels is good is because what we saw in the trade data. Basically, the worst seasonally adjusted saw a minus 10% drop in the deficit, but imports stayed relatively resilient. Like European Union stayed the same as last year. The world overall is slightly bigger. Advanced technology is slightly higher. Asia is slightly higher. Canada is lower, but not by that much, like 10%, 15% lower. This is the deficit. But imports from Canada, in spite of all the drama with Canada, did not decrease significantly. So they went from 44.3 billion to 29.4 billion. And I'm assuming this also is affected by the pull forward of the imports from previous months. So Canada, I think, will stabilize moving forward. Mexico actually slightly lower. Ireland is here because it's half of the EU, but irrelevant right now. India higher, Thailand higher, Vietnam higher, China lower. So what I think happened is basically China rerouted from through Vietnam, Thailand mostly because they have stable supply chains towards the US. So it's easier to hide and also big trade deals with the not deals trade activity with the US. So it's easier to hide their goods inside Thailand and Vietnam. But this is kind of bad for these economies. One of the things that Trump is reproaching to everyone, or specifically to China, is that they are doing trade washing, meaning they're exporting stuff from other countries to their countries. So that's why I said if we get something like Vietnam currently and Thailand are 10% because everything got postponed, but maybe the final rate for Thailand and Vietnam is 15% or 20% because they're enabling China to do trade washing. So anyone that does trade washing, I think, will get punished extra, but in general, everyone else will not. And we have the 10% baseline and a couple of outliers that get more, like China, like Vietnam, like Thailand, and so on. So if this happens, the market will like it. And from the first data that had tariff, it doesn't seem to have affected activity that much. So this means that inflation won't be affected that much and recession odds decrease. Given this setup, my new baseline case is that the dollar goes higher before it goes lower, like I drew here on USD Euro. So this is kind of I leave this here, but I don't believe in it. Or I said I leave this here, but I deleted it. So I think now we will get this cycle repeating itself. We have we will have a breakout. The dollar goes higher before it goes lower, and it's gonna cause problems more than it solves when it go. The weak dollar is a problem for the US. A strong dollar is a problem for everyone, including the US. The combination of tariffs, higher dollar, and will actually affect the economy in a more negative way, because because of the weaker dollar, as you see here, most countries increase their imports. Uh, this is imports to the US. This is from the US perspective. So imports is imports to the US and exports from the US. And as you can see, the weaker dollar actually helped them. They exported more towards almost all jurisdictions in April compared to previous years. So most countries actually exported more, with a couple of exceptions, obviously, China being one of them. But even Vietnam, even Thailand imported more from the US, and that was enabled by the strong dollar. But what will happen when the dollar goes up again? This is gonna be very very unpleasant for the US because their deficit will not decrease at all, and they will have to decrease the deficit by importing less, and that will affect economic activity, that will affect consumption, and that will have a very negative impact on the economy overall. So What needs to happen for things to go wrong in the US is right now for the dollar to go up significantly. That will fuck everything that Trump is trying to do royally. So because that is required, I think that is what is going to happen in the future. Yeah, so talked a lot, said a lot of stuff. I hope I don't get contradicted horribly next week when we get the CPI print. But yeah, that's kind of it for this week. Have a good one. Bye bye.